So, howdy there, all you option traders. Today we're going to show you a typical option trading strategy in which we scout the market for opportunity and pounce on the available opportunities. So, at the moment, the market is in a fairly good mood. People are feeling very bullish, and so the VIX, the volatility index on the S&P 500, is very low. That means volatility, implied volatility as a whole on the S&P 500 is currently at very low levels. Now, the VIX is an interesting instrument. It's not for beginners. It's a bit harder to understand. But one thing I can tell you, the VIX is a mean reverting asset, which means that it always tends to go back to a mean, which is around the mid-20 level. So, whereas in other assets, I feel uncomfortable using technical analysis, with VIX trades, I feel more comfortable doing so because I know that this level of 17 is really a bottom. So if you look back historically, you could see that basically around 16, 15 are the historical levels over the past 3 years. Okay, now the levels have been much higher since the crash of 2008. The last time that the levels were low around 16 was immediately before the market correction in May this year of 2010. So we can see that these levels of 17.46 where the market is trading at the moment is really low. So I want to capitalize on this. I want a position that will benefit as the price goes up. So we're going to look at, at making this VIX trade. Now we saw we're looking at the technical analysis, so I'll just go to the chart here. Again, you can see here, okay, this is a chart for the past 20 years or so. Okay, you can see here that really the levels we are now are at historical lows. This is the crash of 08. Again, you can appreciate this historical lows, and take my word for it, it tends to stay at these low levels only for a short while. Okay, so it'll take up basically a maximum of like 1 month or so until it reaches levels which are well above 20. Okay, so again, going back to here to the analyze page, I'm going to open a position that will be we'll cover this time frame of 42 days. We'll look at a January option chain. And this is open for vertical spreads. Now, I've already chosen a few different trades here, which we'll have a look at on the profit and loss graph. Okay, so the one extreme example is this trade. Okay, this is the 17-16 strike vertical put spread. So you can see here the maximum profit is 200, maximum loss is 800. If you look down here at this area here, you can see the figures. So maximum loss 800, maximum gain is 200, and our break even here is at 16.8, which you can see down here in the bottom. Okay, 16.8. Now, probably the likelihood of it going to these levels of under 16.8 are very low. However, if it does go below that, you're looking at a significant loss. The ratio here is it's a profit of 1 to 4, okay, profit to loss. So I don't like this trade so much. The trade I prefer more is this trade, okay. It's the 1918 vertical put credit spread. So here you can see the break even is 18.6 roughly, okay, with a maximum profit of 1600. This position I've bolstered it up to 40 contracts. I'll explain why later, and a maximum loss of 2,400. But if you ignore the absolute values and look at the ratio, that's a ratio of profit to loss of about 1 to 1.5, if I'm correct. So that ratio I'm a lot more comfortable with, and I'm still quite confident it'll be sometime during the period above 18.6, okay, for this trade. So we'll go ahead and order this trade and see how we do. So keep posted, and we'll show you how we did on this trade. Happy trading, and see you later.